As of 10:37 a.m. Eastern Time, AMTD Digital, ticker HKD, is trading at $2.60 per share, experiencing a significant intraday drop of $0.35, which is a decline of 11.86%. This move is happening on very heavy volume, with 5.4 million shares already changing hands, absolutely crushing its 30-day average volume of just over 316,000. The day's range has been tight but volatile, bouncing between a low of $2.55 and a high of $2.90. Now, the immediate expectation when you see a move like this in HKD is simple. Here we go again. This is the stock that burned itself into the market's memory in 2022 with one of the most absurd, logic-defying rallies we have ever seen, a move that had nothing to do with fundamentals and everything to do with speculative frenzy. So, the expectation is that today's action, especially after a mind-boggling 74% surge just last Friday, is just more of the same, a retail-driven gamble, a flash in the pan. But the reality of what's happening under the hood with this company is far more complex and, frankly, far more interesting than just another meme stock spike. The reality is that just days ago, this company reported a 1,085.9% increase in revenue. Yes, you heard that right, over 1,000%. Suddenly, the expectation of this being an empty shell and the reality of its latest financial report are in a state of total war. And that's where the opportunity and the danger truly lie. Let's establish the common ground. Most serious investors, whether they are managing their own accounts on platforms like Fidelity or Interactive Brokers, or using automated systems like Schwab Intelligent Portfolios, wouldn't touch this stock with a 10-foot pole. They'd look at the 2022 chart, see a stock that went from its IPO price to over $2,500 and back down to virtually nothing, and correctly identify it as a casino. They would much rather focus on the predictable long-term growth stories of giants like Apple stock or the complex sector-defining narrative of NVIDIA stock. The general belief is that HKD is uninvestable. But here's the challenge to that belief. While the stock behaves like a speculative instrument, the business just reported financials that demand a second look. The disconnect is staggering. We're seeing a company with a market cap of around $840 million that just reported half-year revenue of $73.2 million. This isn't a pre-revenue startup. It's a company in the midst of a radical and incredibly expensive transformation. So let's look at the recent trading action because it tells a story. Today's 11–12% drop isn't happening in a vacuum. It's a pullback, a digestion phase after the stock exploded by nearly 75% on Friday, October 31st. That move was a direct reaction to the financial results I mentioned, which were released that morning. The market saw the headline 1,085.9% revenue growth and piled in. This is the kind of volatility that many traders using the Robinhood app dream of, where Robinhood stock trading becomes less about online investing and more about catching lightning in a bottle. Today's volume confirms that interest is still high sky. We are seeing more volume in the first hour of trading than this stock has seen in months. This isn't a slow bleed, it's an active battlefield. The intraday high of $2.90 was an attempt to recapture Friday's momentum, but it was quickly beaten back down to the $2.60 level. This suggests that while the news was good enough to cause a massive short-term spike, the market is now struggling to price in the rest of the story, the part that wasn't in the headline. What is that story? What does AMTD Digital actually do? For a long time, the answer was vague. It was spun off from AMTD Idea Group and positioned as a digital solutions platform. This included a spider net ecosystem, a concept that was abstract and difficult to value. But that's the old narrative. The new narrative, the one that explains the revenue surge, is all about acquisitions. In October 2024, the company consolidated the Generation Essentials Group, or TGE. This acquisition completely changed the company's DNA. Suddenly, AMTD Digital wasn't just a fintech-adjacent entity, it was a holding company for a hospitality, VIP services, and media operations. TGE owns brands like L'Officiel and the Art newspaper. This means HKD is now in the business of fashion, arts, and luxury media. It's also in the hotel and hospitality business. This is the reality that the market is trying to understand. Now, let's get into those numbers because this is where the expectation-reality gap becomes a canyon. For the 6 months ending April 30th, 2025, the company reported total revenue of $73.2 million. This is up from just $6.2 million in the same period a year prior. That is the 1,085.9% gain. Where did it come from? The company's own filings state that this was primarily driven by the consolidation of TGE. The new media and entertainment segment posted $10 million in revenue. The hotel operations, hospitality, and VIP services segment brought in $13.6 million. The company also reported $47.9 million in fair value gains and dividend income on its investment portfolio. This is a crucial point. A huge chunk of its reported income isn't from selling a product or service, but from the performance of its other financial assets. This is a major red flag for those seeking pure operational growth. And here is the other side of the coin, the part that explains today's 11% drop. While revenue exploded, profitability got squeezed. Profit for the period fell by 59.5% to $51.5 million. How does revenue go up 1,000% while profit get cut in half? Costs. Operating expenses ballooned. Employee benefit costs jumped from $2.2 million to $8.6 million. Other expenses went from $4.3 million to $11 million. Finance costs grew by 51.7% to $6.1 million thanks to higher bank borrowings. This paints a picture of a company that bought its revenue growth, and it was expensive. Earnings per share reflects this perfectly, dropping to $0.22 from $0.46 in the prior year period. This is the central conflict. The expectation, fueled by Friday's news, was that HKD was suddenly a growth monster. The reality is that it's a company that has taken on a massive, expensive new set of operations, and the path to making that new structure sustainably profitable is very, very unclear. This is the kind of complex financial situation that requires more than a glance at a smartphone app. It requires a deep look using the research tools provided by services like Fidelity Wealth Management or the advanced platform at Interactive Brokers. So, what is the future outlook here? There are two distinct possibilities. The first is the bullish case. The TGE acquisition, while costly up front, has given HKD a portfolio of real tangible assets and revenue streams in high-growth, high-margin sectors like luxury media and VIP hospitality. The costs we're seeing now are just the one-time integration and expansion costs. Over the next year, management will streamline these operations, and the massive new revenue base will start dropping to the bottom line, leading to explosive profit growth. In this scenario, the stock, even after its recent jump, is dramatically undervalued. The $2.60 price tag is a fraction of what it could be if they successfully execute this new model. This is the bet that some traders are making, perhaps using SoFi Invest to take an active position. The other possibility, the bearish case, is far darker. This view holds that the TGE acquisition is a desperate attempt to create a story, to mask a lack of core growth with a confusing and expensive conglomerate structure. The revenue growth is just an accounting consolidation, not organic success. The massive surge in operating costs is not temporary but a permanent new high, and the company will struggle to ever achieve the profit margins it once had. This is the kind of complex financial situation that requires more than a glance at a smartphone app. It requires a deep look using the research tools provided by services like Fidelity Wealth Management or the advanced platform at Interactive Brokers. So, what is the future outlook here? There are two distinct possibilities. The first is the bullish case where the surge in revenue is the real deal, and the second is the bearish case where the rising expenses are a fatal flaw. Comment below with growth if you think this revenue surge is the real deal, or costs if you think the rising expenses are a fatal flaw. For anyone looking at this stock, whether through a Robinhood account or a more traditional individual brokerage account, the risk is extreme. The stock has a 52-week range between $1.55 and $5.47. Today's drop is just a normal day's volatility for HKD. The reality is that this company's future is a massive